We are definitely in a bull market. Investors and traders are pushing stock prices higher and higher. However, there is one group they are ignoring: luxury companies. The entire sector has been under pressure recently due to signs of weakening demand. However, in the stock market, trouble is opportunity. When a company goes through tough times, investors and traders push the stock price down, sometimes too much. This can create a great buying opportunity. In this video, we are going to analyze two luxury stocks, which I believe are potential great investments. The first stock we are going to analyze is Kering. Kering has a portfolio of strong leading brands, including Gucci, Balenciaga, Saint Laurent, and Bottega Veneta. Gucci accounts for over 50% of revenue and almost 70% of the company's earnings. So it's the brand that has the greatest impact on the company. Due to weakening demand, sales at Gucci have declined recently. As a consequence, sales at the parent company have declined too. I think it will take time for sales at Gucci to start rising again. Other brands such as Louis Vuitton, Christian Dior, and Prada are more popular right now. However, I believe that eventually sales will recover. Gucci is and will continue to be one of the most influential brands out there. In addition, Saint Laurent, Bottega Veneta, and Balenciaga are steadily growing in importance and will help support growth in the future. Now, let's take a quick look at the company's financial statements, specifically at the balance sheet. With 4 billion euros in cash and only 3.6 billion euros in long-term debt, Kering has a pretty solid financial position. The company has a dividend yield of 2.7% and pays 14 euros per share. Kering stock is valued at 18 times both its earnings per share and free cash flow per share. To sum up, Kering has a portfolio of strong leading brands, a solid financial position, and pays a generous dividend. I think the stock is a great buying opportunity at the current price. The second stock we are going to analyze is LVMH. LVMH is a multinational holding and has a portfolio of iconic brands including Louis Vuitton, Christian Dior, Celine, Tiffany, and more. LVMH is not exactly a bargain. The stock trades at 30 times both its earnings per share and free cash flow per share. However, compared to Kering, LVMH has a higher growth rate and a portfolio of much superior brands. So I think that the premium on the stock is justified. LVMH has a dividend yield of 1.4% and pays 12 euros per share. The company is doing pretty well, and as you can see, the stock price reflects it. There has been a minor correction recently due to fears of weakening demand. I believe this is a good entry point. LVMH is the best company in the luxury industry and one of the greatest companies in the world. It has delivered exceptional growth in the past, and I believe it will continue to do so in the future. In conclusion, both LVMH and Kering are wonderful companies and potential great investments at the current prices. I believe that weakening demand is just a temporary problem and will not compromise the company's long-term growth.